You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Well, Murray Sabrin is with us again to discuss the perhaps impending collapse of the global financial system. Murray, you're a professor of finance in my former home state of New Jersey, and I've been following your travails with your various candidacies for years. By far the most qualified candidate, but that doesn't seem to matter anymore in modern America. So we're really thrilled to have you here. What is the state of the global financial system? How much more debt, piling on of debt, can it actually tolerate? What is the new system that's going to emerge to replace the one that we have now, which is quite clearly failing?
We've seen debt skyrocket across the globe because of the pandemic lockdowns, which prompted governments to spend wildly over the last 3 years. And of course, they don't raise taxes to pay for that spending, so they issue an enormous amount of debt, and the central bank buys up a good portion of that creating new dollars and euros and whatever currencies are out there. And so we have a world in a sea of liquidity, which drove up stock prices before the top in January of 2022, drove up bond prices with interest rates declining to the lowest levels in my lifetime. And real estate has gone through the roof. Artwork has gone through the roof. On the weekends, I watched the Mecum auto auctions on Motor Trend cable, and prices are just crazy there. I just saw a Ferrari go for, I think, close to $3 million. It just shows you the amount of money that are in people's pockets around the world that are who are able to just bid up prices. And so with this debt bubble that we have, the question is, can governments continue to finance them given that interest rates have gone up substantially since a few years ago? And that's the dilemma that we find ourselves in, is that once government goes on these spending sprees, and of course we now have huge military expenditures in the United States, and that's increasing around the world as well. So you got the confluence of so many factors which could give us a 1929 collapse. I'm not predicting that anytime soon, because I think there's one or two more rabbits that the central planners around the world, including the central bankers, can pull out of their hat in order to keep the system going, given all the debt that we have.
All right. Well, I would call them central bank planners, because they're central planners. That's what central banking is all about. That's why they need all these statistics to figure out exactly what's happening. Not that they're able to do anything about it. We've seen that amply demonstrated time and time again. So what will they do next? What is the Fed going to do to try to keep the three-card Monte game or the shell game going? Except with the Fed, there isn't a bean under any of the shells, and you'll never find the queen because it's long since been burned.
Well, as long as the banking system is fragile, and we've seen that with the collapse of SVB and Signature Bank, the Fed's got to be worried that there are more shoes to drop in terms of regional banks that are on the brink of insolvency because their portfolios have declined precipitously, because they bought what's supposed to be the safest asset in the world, the long-term government bonds. Those bonds have declined in value as interest rates have gone up, so their portfolios are showing massive declines. And if more banks go under, I think the Fed will stop raising rates. And when they start lowering rates, historically, that means the economy is in a recession. And I expect the recession to really unfold in the second half of this year, which I predicted in a Fortune magazine post in December of 2021. And I just updated that, saying everything that I predicted back then is unfolding right before our eyes. And we're seeing layoffs. That's the key. As layoffs continue in major sectors, that will spread through the rest of the economy, and that's when the unemployment rate starts to jack up, and then that's when the Fed will say, okay, it's time to, quote, stimulate the economy by lowering interest rates again in order to get the next cycle going.
All right. Well, arguably we've been in a recession for several quarters now because the GDP numbers have been down. And when you take into account the understatement of inflation, we've probably been in a recession for a couple of years now. The only thing that could fig leaf that they had to not have to acknowledge such was that employment hadn't come down or unemployment gone up. And now that that fig leaf is gone, they have to acknowledge what really is the obvious because look, if we're growing 1 or 2% and the GDP deflator is at 6 or 7 and the real rate is over 10%, how can you say we're not in a recession?
Yeah, the key for the Fed is unemployment, because they've always lowered rates when the unemployment rate starts to accelerate upward. And right now that's not happening. But I think as more companies announce layoffs, in fact, today McDonald's announced their corporate headquarters are going to be closed because they're going to be announcing layoffs. So even fast food companies are seeing that they're overexpanded in the past, and therefore they're going to have to go tighten their belts in terms of employment. So we'll see how this thing plays out. But the pandemic really distorted the economy to the extent that we've never seen a huge increase in the money supply like we have in 2020. I mean, it was just stunning how much money the Fed created by increasing its balance sheet by trillions and trillions of dollars. And the geniuses at the Fed said, oh, there's inflation here. Well, no kidding. When you increase the money supply by trillions of dollars, that money has to go somewhere, and it goes into the bidding process for goods and services and wages. And that's what we've been seeing the last 2 years.
Yeah, it reminds you of the guy from Casablanca, the French policeman. I can't remember his name. And they said, there's gambling. Oh, my goodness, there's gambling here. I can't believe that. How could that be? Where's that gambling coming from? You know, who would have ever thought? And then they came up with the concept of transitory inflation.
Yeah.
Well, I got news from life is transitory.
Yeah.
But that doesn't make you want to live it any less. Well, inflation turned from transitory to permanent. So your background, you watched a number of inflationary cycles before. How long do these inflationary cycles last for? How long can they last for?
Well, this is the interesting thing. If you look at the CPI data, Consumer Price Index data, the last major inflation cycle we had lasted from the mid-'60s, which is the beginning of the Great Society spending programs, the Vietnam expenditures. That lasted until the early 80s when Volcker raised interest rates in order to get the 12% inflation down. So we had this 15, 17-year cycle in inflation, and you had inflation accelerating, then decelerating, then accelerating and decelerating. So not many people alive today saw that cycle. Those of us who saw that cycle realized that inflation was not going to go away anytime soon until Volcker came in and really put the squeeze on interest rates. And we had a major recession, major downturn in employment. The housing market was killed. The automobile market was killed. But inflation went from 12% to 3% in less than 2 years, which was incredible. And we stayed at roughly that level since until 2021, when we had a 9% inflation rate, to 22 year over year. So the question is, are we on another long-term cycle like we saw from the mid-'60s to the early '80s? And I think we're probably in that cycle because the Federal Reserve is trying to keep this economy afloat by having interest rates as low as possible. We still have negative real interest rates because interest rates on the short end and on the long end are much lower than the inflation rate. So Volcker got the interest rate above the inflation rate. That puts a squeeze on the demand in the economy and causes prices to decelerate, or at least not go up as much. And we're not seeing that phenomenon now. There are very few companies that are lowering prices now. In fact, what they're doing, and the audience should appreciate that, if you go shopping, something that was 16 ounces is now 15 ounces, and yet the price may have either stayed the same or got up 2-3%. So you're talking about a huge increase in prices when companies are packaging their products and downsizing them and still charging the same amount or even more.
Yeah, that's called shrinkflation.
Yep.
And we see that. So this thing short of, look, you can't raise rates to double digits here. The financial system, the government, the country, the global economic system, way more fragile than it was back in the early 80s. Look what's happened at just raising the Fed funds rate to 5%.
Yep.
It's caused major disasters, and this might only be the tip of the iceberg. So do we have a bank run, a massive global bank run where everybody runs to get their money out, or is the Fed, because look, if they'd been doing their jobs, they knew that these banks were in trouble all along, and they could have taken steps before the market realized it and just sold off the banks, merged them. That's their job. And yet they failed at that, Murray.
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
There's no question about it. I mean, this is why we have a veneer of security called regulation. Regulations do not make things better. In fact, they make things worse because you create a moral hazard. Just as people who buy homes at the beach or build it at the beach, and the government steps in when they get wiped out by a hurricane, like we've seen in Southwest Florida last year. So again, the moral hazard in the financial system has been going on literally since day one in the U.S. In the United States, going back 200 years when we had the Panic of 1819 and other panics in the 19th century, where banks claimed they had gold in reserve to back up their banknotes, and they didn't have as much gold, and so they inflated their banknotes, and people got suspicious, and they caused a bank run. Now you have a bank run because people are worried about the solvency of the bank or the liquidity of the bank, so they're taking money out of the banks and going into money market funds and buying, which invest in treasuries, short-term treasuries, which is probably the soundest thing to do today, unless you need to keep a lot of money in a bank, which you should. I mean, there were some companies that had multi-millions of dollars in Silicon Valley Bank, which is not prudent financial cash management. If you have more than $250,000, you should be putting them in a money market account where you can write checks.
Roku had $4.4 billion. That was like a third of their capital. And look, Janet Yellen, it just reminded me of Lehman. She steps forward, says, we're not going to bail them out, blah, blah, blah. And to some extent, that's true. They didn't bail out the shareholders and the debt holders, but they did bail out the depositors. So they put lie to the waste, or they put waste to the lie, that we were going to have these bail-ins, and that all basically, you know what it reminds me of, like when you have the law of the sea, of admiralty, and you got a ship and, you know, it's going to sink. So they got to jettison cargo off the edge of the boat, dump it basically. And what they do is the law says that all the other shippers on that ship have to chip in and make the company whole that they threw the stuff out for. Yep. And, you know, because they actually helped everybody else. And that's the concept of the bail-in. Now, it could work with an admiralty, with a ship going down, but it's certainly not going to work with a financial system that's stretched to the brink and that relies upon the misplaced and misguided confidence of the American public and of really the world.
Well, this is why banking is an accident waiting to happen. And we've seen banking. We had the S&L crisis more than 30 years ago. We had long-term management in the late 90s. And then, of course, the Great Recession, where Lehman went under and other Bear Stearns had to get merged and Merrill Lynch got merged. So the financial system is very fragile because of all the easy money that the Fed pumps in by keeping interest rates below what should be the market rate. Whatever the market rate is, based upon supply and demand. And it's amazing to me, with all the several hundred economists at the Fed working there from prestigious PhD programs, no one is stepping up there and saying to the Fed, don't manipulate interest rates because you're going to create bubbles. No one is saying that, because if they are, they're a lonely voice, and they haven't certainly posted anything about that. But anyone who studies financial history and financial theory and monetary theory knows if you print money, it's going to have adverse consequences down the road. In the short term, it's great for people who are vested in stocks and real estate and other things. But the thing is, when do you get out? And that's the $64,000 question, because we know stocks don't go to the sky. They have corrections. And we're in one correction now. We had the big correction in 2007, 2009. I remember vividly the 73, 74 correction. And that too peaked in January of 73 and didn't bottom out till December of 74. And the market was down nearly 50%. So between the oil crisis back then, and we have a mini oil crisis now, and there are some people who are predicting triple-digit prices for oil in the next year or so. So that's not unsurprising, because the oil market is fragile, the financial system is fragile. We have a hot war in the Ukraine, and people are worried about the implications for that. Taiwan could be another hotspot. So when you add everything into the mix, you can understand the uncertainty that investors have and financial managers as to where to put their money. And right now, a lot of people have stashed money away in money market accounts, and we've got a nice little upturn in the stock market for the first quarter. The question is, what's going to happen for the rest of 2023? Because we know that historically, the third year of a president's term is pretty good, as they try to goose the economy for their reelection next year.
Yeah, very true. If cycles hold true, then we can expect that. But then again, we've got a lot of issues here. Hey, Murray, people want to read your work, connect with you on the web. Where is the best place to find you these days? MurraySabrin.substack.com. I usually post 2 or 3 columns a week. I had a guest commentary today from a former New Jersey assemblyman talking about how we become a banana republic. I cross-post a lot of the other the great writers that are on Substack, because they have insights on topics that I don't do a lot of research in, whether it's medical care or some other issues, environmental issues. So murraysabrin.substack.com. And then, of course, all my books are available on Amazon, from my first book on how to create a tax-free America, from the which I wrote in the 1990s, to my latest book, my autobiography about my life in America, coming to the U.S. as an infant in 1949 and going through the school system and becoming a college professor, and then running for governor in 1997. Okay, so I just want to go back. You said Banana Republic. This is something, it's a term that's bandied about. There's even a clothing store called Banana Republic. And this was coined, it's a term coined by O. Henry to describe Honduras and Costa Rica under economic exploitation by U.S. corporations, mainly the United Fruit Company, which is Chiquita International. And basically, we controlled these countries. We put in people. If we didn't like who was running it, we would just kick them out. So the United States has a rich history controlling banana republics, and now I guess we're becoming one.
Well, actually, 30 years ago, I coined the term HighTech Banana Republic, because now with the internet and all the technology that we have, the government has its hands all over the place. We saw what happened with Twitter and other social media platforms. The FBI was there telling them there's disinformation going on without any proof, just asserting that. And so that's the danger of the merging of tech and the government, is that you get a HighTech Banana Republic.
Exactly. And that's where we are now. HighTech Banana Republic. Murray, pleasure. If you've got a question for Murray, shoot us an email, kl@kerrylutz.com, and go over to the site for the show notes. You'll find his link, and it's financialsurvivalnetwork.com. While you're there, please sign up for your free newsletter. Murray, always a pleasure. Thanks for coming by.
Thank you so much, Kerry. Appreciate the opportunity.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.